Welcome back. I'm Salome, and today I'm joined by Doug Laxton, founder of the Better Policy Project. Doug, there are already many public policy institutes out there. What makes the BPP different?
Thanks, Salome. The key is in the name. We see ourselves as a project rather than a traditional institute. We focus on specific goals that can be achieved within a reasonable time frame. Our mission has three main pillars: raising economic and financial literacy, improving the analytical frameworks used by policymakers, and strengthening how policy is communicated to the public.
And that mission brings us directly to today's topic: energy markets and the risk of higher inflation. On August 11th, the US Energy Information Administration released its latest short-term energy outlook. Its baseline for Brent crude is around $85 per barrel in the third quarter of 2026, before declining to $78 in Q4 and averaging roughly $16 in 2027 as supply conditions normalize. Doug, what is the economic thinking behind that forecast?
The conventional narrative is essentially one of mean reversion. Current oil prices reflect significant geopolitical and physical supply risks, but standard models tend to assume those disruptions gradually fade. Shipping conditions improve, other producers respond, inventories recover, and oil prices move back toward longer-run levels. That's a reasonable baseline. But the important question for policymakers is, what if this shock doesn't behave like previous shocks?
And one potential blind spot is asymmetric warfare. Modern conflicts increasingly involve relatively inexpensive drones and uncrewed vessels challenging extremely expensive defense systems.
Exactly. The economics are important. An attacker might deploy a drone costing tens of thousands of dollars, while the defender may need an interceptor costing millions. Even when interception is highly effective, defensive capacity isn't unlimited, and persistent threats can keep insurance costs elevated, disrupt shipping schedules, and create continuing friction around critical maritime routes. So instead of asking whether the disruption disappears in 3 or 6 months, policymakers should also consider a scenario where higher transportation and energy costs become more persistent.
So let's stress test the baseline. What happens if oil doesn't fall towards $69, but instead comes under sustained upward pressure toward $120 a barrel?
Then the inflation outlook becomes considerably more complicated. First, higher energy costs feed directly into fuel prices, transportation, and logistics, pushing up headline inflation. Second, energy prices are extremely visible. Consumers see fuel prices constantly. If they remain elevated long enough, inflation expectations could start moving higher. Third, central banks face a difficult trade-off. The Federal Reserve, Bank of England, and ECB may want to lower interest rates as growth slows, but renewed inflation pressure could make aggressive rate cuts much harder to justify. That combination, weaker growth alongside persistent inflation pressure, is exactly the type of scenario policymakers need to stress test.
And that brings us back to the importance of scenario analysis. A baseline forecast is useful, but policymakers also need to understand what happens when the world evolves very differently from that baseline.
Exactly. Prudent risk management means preparing for important alternative scenarios rather than betting everything on the central forecast.
And that's a major focus of our upcoming Better Policy Project workshop in Prague, December 7-11, titled The Prudent Risk Management Approach for Monetary and Fiscal Policies.
We'll work on scenario modeling, stress testing macroeconomic frameworks, and translating those risks into practical policy strategies.
If you're an economic forecaster, analyst, central banker, policymaker, or student interested in strengthening your analytical toolkit, visit betterpolicyproject.org for more information. And if you found this discussion useful, please like, subscribe, and share your thoughts in the comments. Thanks for watching, and we'll see you next time.